Thanks for tuning into BQ Conversations. I'm your host, Neeraj Shah. It's always a great time to talk about what could happen to the Indian economy over the course of a particular year at the end of the previous year. And that's what we're trying to do today, trying to talk about what the macro for India for 2023 could likely be. Our guest today is Sonal Varma. Sonal, great having you. Thanks for joining in.
Thank you.
What's your sense, Sonal? I mean, most people talk about how for the world, this is a completely different cycle than what it has been in the past 30 or 40 years in terms of what rates are showing about how they'll stay. What are your thoughts around there, and how does India fare within that landscape?
So the global backdrop actually is the biggest challenge India faces for next year. And as you said, the synchronized policy tightening we've seen globally this year has been quite significant in the light of high inflation. And I would say importantly, even as there are signs that, for instance, the industrial sector, export growth across a number of countries, housing market in the US, so signs of slowdown clearly visible, yet central banks still looking to hike rates, maybe at a slower pace, but continuing to hike rates and stay at that restrictive territory through most part of 2023. So from our standpoint, we think that 2023 is going to be a year where globally GDP growth is going to disappoint on the downside. We are expecting recession in US, Europe, as well as some of the countries which are more housing driven and where mortgage rates have increased materially. So the likes of Australia, Canada, New Zealand, South Korea. So essentially, it's a synchronized slowdown with recession in some of the advanced economies. Now, China, of course, is seeing sort of a delayed reopening and therefore seems better off compared to rest of the bloc. But from a demand standpoint, I think that's going to be the biggest challenge for India in 2023.
The belief is that while and I would love to understand about okay, let me try and actually talk about that first. So now, in light of how people look at different economies, and I was talking to Rob a few days back, your colleague Rob, and he was saying that if we look at India versus how India might have been, it will not look as great. But when you look at India vis-a-vis what a lot of other emerging market economies are doing, it might seem a lot better. How would you, in your prism, look at India in that landscape, therefore?
So, it really depends on what perspective one is taking. But I think the relative comparison of, let's say, a domestic demand-driven India versus an export-driven, let's say, Singapore or South Korea, clearly in a recessionary backdrop, some of the export-oriented open economies will be hit a lot more. Some countries, for instance, in Korea, we think growth will in fact contract in 2023. So compared to that, some of the more domestic demand-driven economies, India is one of them, but also the likes of Indonesia, where growth rates will slow down, but will still on a relative basis stand out. On an absolute basis, though, I think, this idea of decoupling is raked up ahead of every slowdown, never works out. And that's something that we think will also play out in 2023. So our calendar year 2023 real GDP growth for India is around 4.5%. You compare that to, I think the consensus right now is closer to 6%. So relative to 2022 and relative to expectations for 2023, we do think it's going to disappoint. Why? Because one, of course, the export demand is going to weaken even further, despite the rebound we've seen in the November exports. Two, importantly, the investment cycle is closely linked to outlook for demand, certainty, and how financial conditions are. And all those three actually take a hit when you are in a synchronized global growth downturn. So we do think we will start seeing investment-related indicators actually slow down in India. And some of the small and medium enterprises which are more export oriented are also labor intensive. So there is some spillover on the consumption side, job side as well because of the export slowdown. So I would say, like on a relative basis, India versus some of the open economies, India stands out as being better off. But there is no decoupling. There will be also a growth hit for India.
Hmm. What are policy choices in such a scenario, Sonal? We have the budget coming up, the last full budget. Maybe the government needs to do that capex push, but if the rural consumers hurting in the recent past is any indication, piece of the puzzle isn't solved either. So it's a bit of a tightrope. How would you look at what are the policy choices before, and what is it that might please you as somebody who watches the economy so closely, versus what is it that might uh, stand out as a sore point, depending on which choice the government makes?
Sure. So let me take your first question first in terms of policy choice. I think the trade-offs, I would say, are becoming less stark. In fact, 2022, while it was a decent, good year on the growth front, it was a lot more challenging year for policy because we were also trying to deal with inflation and currency-related challenges. So the trade-offs were quite stark. Incrementally, some of those pressures are easing off. Inflation, of course, core inflation is still sticky. But given the moderation in commodity prices and the expected moderation in growth, some of these inflationary pressures will ease off. And oil coming off itself also implies that the trade deficit starts to narrow. So the trade-offs are less stark. And for monetary policy, therefore, it's, the RBI has effectively taken the reverse repo rate 335 to an effective repo rate of 6 quarters. So it's been nearly a 300 basis point rate hikes in a very short period of time. Now, monetary policy works with long lags. Global growth is going to slow down. Commodity prices are under check. And therefore, core inflation will come down. So we do think that the monetary policy tightening cycle is more or less behind us. There will probably be a last hike in Feb, post which policy goes into a pause. And if we are right on the growth inflation outlook with both looking weaker, then in fact, we think monetary policy could very well move into an easing mode also in the back half of FY24. Now, on the fiscal side, the weaker growth outlook will mean the buffer we had this year in terms of higher tax revenues will not be there next year. So we do think consolidation is going to be more difficult next year. And the point you made around rural being weak, I think one of the biggest challenge for rural consumption has been high inflation. So to the extent that inflation is easing off, real rural incomes actually should do better. So in fact, when we studied the past global slowdowns and impact on India, it is exports followed by a pretty significant impact on investments. And consumption ends up being a relative buffer. Again, within consumption, you would expect the urban discretionary side to see a bigger hit compared to rural, which I think should hold up given inflation is actually coming down. So the need for the government to essentially focus on front loading their public capex projects continues, but fiscal consolidation is going to be challenging. On the second part of your question of what we see in the macro framework, which will make us positive or negative. Now, I mean, we do think that a lot of the challenges that India is facing today are global spillovers. There is nothing that India has sort of done wrong. If anything, balance sheets are much better both for banks, corporates, policies generally are prudent. So India also has the ability to bounce back faster. Uh, you know, let's say on the other side of the global slowdown, because some of the headwinds today will turn into tailwinds. For instance, commodity prices coming off is a positive terms of trade shock. Fed, in our view, will go on a hold after March and then start easing after September. So financial conditions will ease and investors will look for a stronger growth story. And we do think India will see a V-shaped rebound in calendar year 2024, where we're expecting growth of about 6.7%. So the priority for policymakers, I think, during this interim period is essentially to ensure that from our perspective, the macros remain positive and the policy choices that we make remain prudent and long-term oriented. I think that's the main focus because on the other side, as I said, India could rebound faster.
Okay, two follow-ups. The picture that you're painting about the consumer consumption patterns coming up ahead is a stark reversal of what is there currently, because currently urban discretionary is doing really well and rural isn't. So what you are effectively saying is that the reverse could happen, which kind of makes the policy choice, to my mind, pretty easy, right? Because the government then doesn't have to focus as much on reviving the rural income as opposed to creating jobs and capex, and therefore focusing on the investment side.
So the urban consumption bouncing back faster post-pandemic wasn't really a big surprise given they had more savings, right? So now the impact you're going to see is, for instance, on some of the white-collar jobs, potential negative wealth effects. The rate hikes that the RBI has done will typically end up hitting the discretionary side of consumption, not the non-discretionary side. So from a policy perspective, I think there is therefore some sort of an automatic stabilizer here with discretionary consumption coming down, inflation coming down, and that being a positive for rural. Now, a more durable rural recovery, of course, still requires job creation. So, this in no way means that we take our eyes off the need to kickstart or, get the investment cycle going. So, I think the focus, therefore, for the government in the next 12 months, where we think private investments will get postponed, would be to continue on the public capex side, because if you're creating jobs in the construction sector, then that becomes a more sustainable way of sustaining rural consumption beyond the initial positive thrust because of, let's say, lower inflation.
One quick question on how have you read the different kind of sound bites coming around both government and private capex, in that a lot of chatter around government capex still staying okay, but we've seen the roads infra construction, for example, not quite up to speed compared to the past. And on the private side, as you mentioned, postponement, deferment, what have you, and yet the headline numbers about investments in the PLI schemes, green hydrogen, data center, a bunch of global companies making a beeline for India, those headlines continue. How do you dissect, or how do you distill the wheat from the chaff here?
So, from our perspective, a turn in the capex cycle has still not happened. While the supply side conditions are in place in terms of better balance sheets, the decision to invest is always a function of demand visibility. And I think that demand visibility may not be there in the next 12 months given the global backdrop. And therefore, the turn hasn't happened and is likely to get postponed further. Perhaps FY25, there are higher chances of seeing a pickup, but I won't say FY24. Now, we do, of course, this is the aggregate picture. Now, what's happening, I think, is that within this aggregate picture, there are pockets where you are seeing, an improvement. So it could be on the electronics side for PLI, for instance, government pushing on capex on non-roads related projects, could be on the renewable side. So there are pockets where you are seeing, some improvement, but it's just that at an aggregate level, we don't think the investment cycle is yet turning around.
Right. So a final couple of questions. One, um, foolish to preempt what will happen in the budget, but I'm still requesting you to try and second guess as to what do you reckon would be the central driving theme. Would it be a focus on trying to push growth via capex and investment from the government side, or would the focus largely be on fiscal consolidation, considering that this is also the final main budget before the elections happen next year?
All of the above.
Okay.
So when the budget is presented in Feb, the focus on sustaining growth via capex should continue given the global growth backdrop. And some of the savings that the government will have because of lower food or fertilizer subsidy uh, can also be used, and I think is likely to be used for fiscal consolidation. So, if medium term we want to get from 6.4 this year to 4.5, by FY26, then the glide path for fiscal would basically indicate that FY24 budget estimate for fiscal deficit should be around 5.8, maybe up to 6%, but definitely better than 6.4. On the on the consumption side, I think the focus on more allocation to agriculture and rural themes may be there this time around. It also is necessary from an economic standpoint. Anything that can boost productivity and investment in those growth areas, should be there. But we are not really expecting any big changes for middle income in terms of taxes, because typically, any cuts, for instance, on taxes ends up being saved rather than consumed. So you don't really get the bang for the buck. So I think, the ability to allocate more to, lower income or maybe more agriculture, rural kind of themes, public capex, while consolidation is likely. But as I said, the FY24 fiscal deficit, what is budgeted in Feb versus, how the actual estimates track during the course of the year is what we will be watching more closely, because if growth disappoints, then the ability to meet the targets that are set in February may be difficult.
Got it. My final question is on the revenue numbers. We know that divestment proceeds have not and likely will not see the light of the day by any stretch of imagination. Tax buoyancy still continues on the GST side, at least. How do you think the country's position on that front?
On the revenue front, I think this year is definitely looking reasonably good on aggregate. So, we have actually spent a lot more on food subsidy, fertilizer subsidy. We've lost some revenues on the excise front. But the buoyancy on GST and overall on direct taxes has been more than enough to offset the undershoot that is likely on disinvestment and maybe even on dividend side. So on the whole, that plus this year, the nominal GDP growth in FY23 will end up being close to 16-17%. So the denominator in the fiscal deficit is also a big savior for the government. FY24, our own estimate is nominal GDP growth will end up moderating to closer to maybe 10.5%. And therefore, the revenue buoyancy we have seen in FY23 may not continue. And even on GST, you mentioned, it's been very good. It has been, but the last few numbers are showing some sequential softening, which is in line with our view that cyclically the economy is actually going to slow down. So the dependence, therefore, on perhaps asset monetization and other sources of revenue might be a lot more in FY24. So I think balancing the fiscal will be a big challenge in FY24, but it's not a challenge this year.
Well, hopefully FY25 comes in sooner than otherwise. But Sonal, thank you so much for taking the time out and speaking to us today. Much appreciate your time.
Thank you very much.
And viewers, thanks for tuning in.